Depending on which markets or sectors you are trading in the equity market right now, you might find the stock market to be very disappointing lately. The Dow and the S&P 500 did break new highs recently, but stock selections has been tricky. And not to mention that we have just seen a rather flash pullback just yesterday. The Nasdaq, on the other hand, is even worse. It seems like giving traders some hope, but right after we are ready to plot our entries, or right after we have just established a positions, a correction will kick in and positions are very likely to be stopped out. To make things even worse, not too long after that, the exact same counters or maybe some other counters might show some sign of recovery again. And that vicious cycles basically just repeat. This situation is often referred as whipsaw. This kind of market situation is just tedious to trade, and oftentimes it just doesn't make sense to trade at all. So in this video, let's talk about what I do when trading doesn't make sense. And if you stay until the end of this video, I'm going to share with you some tips based on my personal experience that might be useful for you to improve yourself as a trader and investor. What's up everyone, this is Jin Hao. Thank you for tuning into this video and I wish you are doing well. Here in my channel, I share about my personal opinions and experience on my journey in trading, investing and personal finance, just like this one. So if you are new here and you are interested in these topics, consider subscribing. Before we proceed further, here are some quick disclaimers. I'm not a licensed financial advisor and I'm not licensed to give you any financial advice. Whatever I share in this video are solely based on my personal opinion and experience. There are no buy or sell solicitations in this video. Do your own due diligence and practice independent thinking when it comes to consuming this kind of content on the internet. Alright, so right now, let's move on and talk about the market. This is not the first whipsaw I have experienced and definitely not our last, unless you decided to give up and declare that you are defeated. So, since this is not the first nor the last whipsaw that we are going to experience, I think the right thing for us to do is learning how to embrace it and manage it. Every time the market is having a whipsaw, I accept it and I learn new things. Whipsaws are not market crash or crisis. Crash or crisis are typically referring to a downtrend or substantial fall in prices, like last year when the market crashed after the COVID-19 global outbreak. At a most generic level, crash is easier to handle than whipsaw because it is as easy as sell now and buy back later. The damage is probably just once unless you try to do something fancy in the middle of the crash without any proper risk management. And even for amateur traders who fail to execute stop loss might even break even or make some money if they are lucky to hold until the market recovers from the crash or crisis. Whipsaw, on the other hand, is a completely different story. Whipsaw is when the market is not going anywhere. It is not really going up and it is not crashing either. Counters can go up and display entries to you and fail later. Once you are stopped out, it might recover a little bit to continue teasing and trapping people. The longer the whipsaw, the higher the chance a person's patience and confidence are going to be slowly depleted to an extent of losing self-confidence, losing confidence with their trading strategies, having doubts with their current strategies, or even losing confidence in the market entirely. One word, it is a torture even for trained traders because there is no set rules as to how to manage or avoid whipsaw movements in a volatile or highly uncertain market. For people without risk management, it is a disaster. Right now, the market does not crash. DJI and S&P 500 are still technically at all-time high region, and Nasdaq's primary trend is still up. Just that it is very volatile, and right now it seems like behaving in a way that most people cannot endure, especially traders. Plenty of stocks are still trading at their all-time high region, and it is just the stock selection is tricky, as in great ones do not usually have opportunities to enter, and what we are presented are usually stocks with subpar setup whereby the movements are unusually unpredictable. The previous whipsaw was 2018, I would say. During that year, my portfolio went from a positive 20 level to the lowest point of negative 20 level. For those who understand the concept of risk multiples, we are talking about 40R of portfolio volatility. To put things into context, 10R volatility is enough to put someone without proper risk management into big troubles that are devastating. The great thing is, I survived thanks to proper risk management. I often say that the market is for the survivors. The only thing that I wasn't satisfied was that I did not survive with flying colors. Yes, I did survive as a trader, but after post-mortem sessions with myself, referencing some other professional traders and investors around me, I came to realize that things can be done better. I started building an investment portfolio with ETFs during the following year, and thankfully I did. During last year's crash, which is 2020, things progressed phenomenally. After hitting all my trailing stops in my trading portfolio, the market continued to fall and I started to collect S&P 500 index ETF for every predetermined percentage the market falls. Basically, I switched a portion of my funds from trading portfolio to my investment portfolio because when the market does not make sense to trade, it usually makes some sense to invest for super long term. Last year, which is 2020, S&P 500 calendar year return is 18.4%, while my investment portfolio has a calendar year return of close to 37%. Considering that this is a portfolio that I did close to nothing, the return is fantastic to me, and not forgetting that my trading portfolio has a gain of 97% in 2020. Now, some people might say I could have done better if I did not invest and I trade with whatever capital I have, as trading was so lucrative last year and my investment portfolio basically diluted my overall return. But again, these kinds of statements are kind of pointless when we reference things in such a retrospective manner. What if the market did not recover rapidly like it did after the crash and instead entering into a whipsaw market? It would be a torture to trade 100% of my capital in a whipsaw market. This time round, we can tell that it is a whipsaw. It is a period of torturing time, especially if you are purely eyeing on Nasdaq recovery. The market weakens starting from February. I started to reduce positions from February until March. And right now, the market remains very challenging and I have not been taking positions aggressively since then. Again, when the market does not make sense to trade, it might make sense to invest. Not always, that's why I use the word might. As we already know, Nasdaq is weak this year so far as it fell more than the Dow and S&P 500 did and recovers slower as well. It fell by my predetermined percentage level and I went ahead to top up some Nasdaq ETF for investment purposes. Despite all the challenges in trading, I still appreciate what I have for my trading portfolio so far. The unrealized gain year to date is around 10.8%. You might think that this is good, but it fell from above 20% gain to this level. Basically, most of the gain was made earlier this year during January. Most people cannot take it, but I know that it is just a normal thing in this journey. We cannot always reap profits at the highest level. If you always want to take profit at the highest point, this expectation is going to make your journey in the market pretty emotional. For the Nasdaq ETF I have scooped 2 months ago, it is making me 6.3% at the point of recording this video for that single position only, which means excluding positions I've taken earlier on. And no matter how bad you think the market is, S&P 500 index ETF that I've invested earlier has a year-to-date gain of slightly above 10% on top of the calendar gain of 37% last year. So the idea here is having 2 equity portfolios, one for trading and one for investing. Some might ask, why the hassle? Why not just focus on a single portfolio with an approach or strategy that you are more competent with? From what I have experienced as a trend follower in the stock market, there will be times whereby the stock market will turn weak and the majority of our positions will be stopped out, if not all. And there will be times whereby the stock market would suffer whipsaws, whereby stocks that we enter can be easily stopped out and the stock market is just going nowhere. During this kind of market situation, it usually does not make sense for traders to trade aggressively, and what I realize is that it usually makes some sense to look into collecting some of the great stocks or ETFs for investment purposes. You see, when most of your positions are being stopped out due to market weakness or whipsaws, you have increased amount of cash in your trading account of your trading portfolio. You can actually withdraw a small portion of the money inside that trading account and put it into an account of your investment portfolio. This move has several benefits. The first one, Usually when your trading positions are being stopped out altogether or one after another, it probably means that the market is weak and it does not make sense to trade aggressively, or it may not even make sense to trade at all. During this kind of market situation, it usually makes sense to collect some great ETFs that would go up in long run for long-term investment purposes. My favorite are the S&P 500 Index ETF and the Nasdaq Index ETF. When the market recovers, we may or may not be quick and decisive enough to re-establish positions in our trading portfolio due to many internal and external factors, but great index ETFs would usually go up in prices when the overall market starts to recover. The second benefit would be preventing us from overtrading. When a person suffers a series of losses, it is easy to overtrade. Everyone knows that overtrading in a weak market sentiment can be very disastrous, but it is easy to say than done. Having revenge trade is never a good thing. Therefore, after the positions are being stopped out one after another, we have to acknowledge that the market is probably turning weak. Reducing the size of our trading portfolio is a very good way to reduce the damage if we were to overtrade with revenge trade and things get out of hand. This is extremely useful for those who tend to take revenge trades or overtrade when they should not. Another thing that happened just on time after most of my stocks were being stopped out in February and March, I started to seriously look into cryptocurrencies because of the trend during that time. During the market fall on February and March this year, apart from taking some money out to invest in the Nasdaq Index ETF, I also took some money out and invest in cryptocurrencies, mainly Bitcoin and Ethereum. At a point of recording this video, Bitcoin is almost back to my average cost price, while Ethereum soars by more than 150%. I allocated only 1% of my total portfolio size into cryptocurrencies, and right now it is growing. Again, not too shabby, at least for me. It took me close to a decade to achieve this kind of flow state whereby whatever the equity market becomes uncertain, I know how to respond to it with emotion control. Is it easy? Definitely not, especially if you are just starting out and having limited capital. If someone were to tell you that this is easy, he or she is probably lying. Here are the things that might help you to progress in this journey. First one, find a financial vehicle and strategy that is the best fit for your current situation. For example, stock investing, ETF investing, stock trading, and so on. You have to consider the time and effort that you can commit. For example, if you are spending most of your time working for a desk-bound 9-to-5 job and you have other commitments after working hours, then probably trading is something that would consume too much of your time, as you need to consistently look for trading opportunities in the market. That might not be for you. Number two, understand the pros and cons of that financial vehicle and the strategy you adopt. For example, if you were to start with stock trading, you might be making great profits in the bull run, but you will probably find it stressful and emotional to trade when the market has whipsaws. Nothing is perfect, although it is the best fit for you. Sometimes the best fit refers to something that you have to make the least compromises. Number three, understand market has cycles. Know what to do when the winter for the particular financial assets and strategy is coming. Just like right now, the stock market does not make sense to trade aggressively. Accept and embrace bad times. More importantly, know what you should be doing during these times. Number four, grow your active income source. Continue to work on things that you are good at to increase your active income source. This is a great way to increase your income, give you more capital to trade and invest while diverting your attention from your portfolios, which may create unnecessary emotion. Number five, keep learning and exploring multiple investment vehicles and asset classes. In the beginning of my journey, I focused on stocks only. Slowly, I started learning futures trading to increase my trading income. And if you watched my video before, you know that I was not an early believer of the cryptocurrency and blockchain. But right now, I'm diversifying into these digital assets. Last but not least, number six, complain less, contribute more. It is never easy, because if it is easy, then there will be no poor people in the world anymore. As a trader, if you are frustrated with the current market, learn how to take a break. Tough times never last, but tough people do. Come back again and rock the market when it is recovering. Take this opportunity to learn something else as well. So that will be all for this video. I hope that you are getting some ideas on how you should plan and structure your portfolio and journey in the financial market. Again, these are not financial advice. I'm just sharing based on what I know and what I have personally experienced in my journey. So if you find this video helpful, do not forget to drop a thumb up on this video for the YouTube algorithm. That's always appreciated. Subscribe for more future updates, sharings, or analysis. Meanwhile, don't forget to check out my other videos. Thanks for watching, and I'll see you soon.